Welcome to the deep dive. Our mission today, well, it's pretty straightforward. We're going to quickly but thoroughly get into Capital One's third quarter 2025 results. They just dropped yesterday.
Right.
And, normally quarterly earnings can be a bit routine, maybe, but this time, wow, the numbers are just completely dominated by one massive event.
Yeah, the Discover Financial Services acquisition. It's the first full quarter impact.
Exactly. It's everywhere in these results.
It really is. And when you have a deal this big hit in the books, the raw numbers, what we call GAAP numbers.
Generally accepted accounting principles, right?
Exactly. Those can look, well, kind of chaotic. So our job here is really key. We need to separate the signal from the noise.
Okay.
We have to look past those volatile GAAP results to the adjusted figures.
Yeah.
The ones that strip out the big, maybe one-time, maybe temporary costs tied just to the merger.
So we can see the underlying bank performance.
Precisely. See how it's doing day to day. The big picture here is huge revenue growth, absolutely massive. But you got to understand the significant integration costs layered underneath it all.
Okay, let's start with that volatility you mentioned. The headline GAAP number. Net income of $3.2 billion for Q3. That works out to $4.83 per share, which sounds good, but it's an incredible swing, isn't it? Because just last quarter, Q2, they posted a net loss of $4.3 billion.
A huge loss, yeah, 8.58 per share.
So what explains that massive turnaround in just 3 months? It seems almost too fast.
Well, that Q2 loss wasn't really about the bank suddenly performing badly. It was mostly that initial accounting shockwave from the merger hitting all at once.
Okay.
You think of it like this. The moment they bought Discover, accounting rules forced them to book a massive reserve, like a big safety deposit, against all the loans they just acquired, just in case.
So that hit Q2 profits immediately.
Instantly, yeah. So now in Q3, we're seeing the operational strength after that big accounting hurdle. If you look at pre-provision earnings, that's profit before worrying about potential loan losses.
Right.
That jumped 29% just from Q2, hit $7.1 billion. That tells you the core engine is running strong.
Okay, that makes sense.
And total net revenue, also way up, 23% quarter on quarter, landing at $15.4 billion.
That revenue growth takes us right to the net interest margin, the NI, basically how profitable their lending is. And that jumped by a frankly staggering 74 basis points compared to Q2. It hit 8.36%.
It's a big move.
It is a big move for NIM. So the key question here strategically is that sustainable? And what does that level of profitability mean for them versus competitors?
Right. Well, the main driver is pretty clear. It's the full quarter impact of having Discover fully in the numbers.
Okay.
They basically absorbed, overnight, a higher yielding credit card and payments business. So that's an immediate boost. Combine that with better yields on their own, legacy Capital One cards.
Right.
And yeah, the acquisition has fundamentally changed their lending profitability. If you look at the adjusted NEM, smoothing out some noise, it's even stronger, 8.43%.
Wow.
And what's really interesting strategically, like you said, is that having a sustained high NIM like this lets them compete much more fiercely on things like card rewards and marketing spend.
Gives them an edge.
Yeah, structural advantage against maybe more traditional banks that often operate with much lower NIMs.
That underlying strength is compelling. But we have to talk about how management wants us to see these numbers. The CEO is really pointing everyone towards an adjusted EPS of $5.95.
Right, much higher than the GAAP, $4.83.
Exactly. So we're basically ignoring or adjusting out over $1 billion in costs just this quarter. Why should we, or you listening, be so quick to just dismiss that $1 billion and only focus on the adjusted number?
That's always the critical question with adjusted earnings, isn't it? And it really gets to the heart of how companies report. The argument for the adjustments is that they're meant to separate the day-to-day running of the operating bank from these temporary or purely accounting-related costs that come with digesting a huge merger.
Okay, so they're saying these costs aren't part of the real business performance.
That's the claim. They're saying they're non-recurring or they're just artifacts of merger accounting rules.
Can you break down what those costs actually are, that billion plus we're adjusting out?
Sure. If you sort of group them conceptually, they fall into maybe two main buckets. First, you've got the real hands-on operational costs of putting the two companies together.
Like IT systems.
Staffing. Exactly. Merging IT, maybe some severance costs, consolidating offices, things like that. That was about $350 million this quarter.
Okay. Still a big number.
It is.
Yeah.
But the second bucket is actually bigger, and it's more of an ongoing accounting thing. It's the cost of putting the assets they bought onto their books.
How does that work?
When they bought Discover, they had to estimate the value of things that aren't physical assets, like brand value, customer lists, intangible assets.
Right.
And accounting rules say you have to spread the cost of those estimated values over their expected useful life. That's amortization. And that, plus some related fair value adjustments, accounted for over $600 billion this quarter.
So it's like depreciation, but for intangible stuff.
Kind of, yeah. You can think of it like the ongoing mortgage payments for the acquisition.
Yeah.
Management wants you to look at the operating cash flow before those payments, but they're still real expenses hitting the bottom line.
Speaking of those valuations, the documents confirm the sheer scale here. They've revised the preliminary goodwill estimate for Discover. It's now pegged at $13.778 billion.
Almost $14 billion in goodwill.
Yeah, how solid is that valuation? You always hear about goodwill being written down if a merger doesn't go as planned.
Well, that number definitely confirms they paid a hefty premium over the value of Discover's tangible assets, its physical stuff, and basic book value. And to your point about risk, we can actually see what they value most within that deal price. The total projected amortization for all the acquired intangibles is around $12.6 billion over their lifetime.
Okay.
But here's the key part. A massive chunk of that, $10.1 billion, is specifically allocated to something called Purchase Credit Card Relationships, PCCR.
$10 billion just for the existing Discover customer relationship.
Essentially, yes. That's their bet. They're placing enormous value on the stickiness and profitability of those millions of Discover cardholders.
So if those customers don't stick around as hoped, or if the expected synergies don't happen fast enough?
Then that $10.1 billion intangible asset becomes a huge liability. It would have to be written down, impaired, which would mean big future GAAP losses. It's a major bet on integration success.
Okay, so if that $10 billion bet on customer relationships, the PCCR, is the core engine that bought, let's see how fast that engine is actually running right now. The credit card segment is obviously key.
Absolutely central.
Period-end loans there total $271 billion. That's a huge base.
And we're seeing immediate energy, like you said. Credit card purchase volume, that's the actual spending people putting on the cards, that jumped 14% just from Q2. And compared to a year ago, up a really impressive 39%.
Wow, 39% year over year.
Yeah. And the card segment's total net revenue reflects that, up 28% quarter on quarter to $11.6 billion. It really shows the immediate impact of just absorbing Discover's existing business and cardholders.
Okay, let's switch gears slightly to the consumer banking division. That's mostly their auto lending business, right?
Primarily auto, yes.
That segment's growing too, but looks a bit more modest. Ending loans were up 2% from Q2, reaching $83.2 billion. Auto loan originations, though, were up 17% compared to last year.
Right. Steady growth there. But what's really striking, I think, is how the sheer power of the combined payment network shows up now.
How so?
They've introduced a new metric, global payment network volume. This lumps together the volume going over the Discover network itself, plus the PLSE debit network volume they acquired.
Oh, okay. And what did that hit?
$153.1 billion this quarter.
Oh.
Yeah. That's an explosive 107% increase just from Q2.
Yeah.
It gives you an immediate, really tangible sense of the reach they bought.
Yeah.
It's not just about the loan book. It's a global payment platform now.
Right. A much bigger footprint in payments. Okay, now we absolutely have to talk about credit quality and losses, because just looking at the surface, this quarter looks fantastic on the credit front.
It seems that way initially, yeah.
The overall provision for credit losses, the money they set aside, decreased dramatically. It fell by $8.7 billion compared to Q2, down to $2.7 billion.
A huge drop.
So does that mean we can just declare victory? Is it a major credit recovery happening across their entire loan book?
It's much more nuanced than that. You really have to unpack the different trends within that number.
Okay.
So the good news driving that big decrease is partly because the company actually released reserves this quarter. They took back about $760 million from their overall allowance for credit losses, the ACL.
A reserve release.
Right.
Why?
They said it was primarily driven by continued recent favorable credit performance, specifically in their huge domestic card business.
Ah, so the card portfolio is doing better than expected.
Exactly. And you see that reflected in the card net charge-off rate. It actually improved from Q2, dropping 59 basis points down to 4.61%. That's a positive signal of stabilization in their most critical segment.
There's always a but, isn't there? If we drill down into the consumer banking segment, specifically auto loans, the picture looks quite different. It actually got worse.
It did. Significantly
The
worse.
net charge-off rate in auto increased 28% just from Q2. It went from 1.3% up to 1.58%.
Yeah.
So doesn't that sharp divergence, card credit looking better, but auto credit actively deteriorating, kind of undermine the optimism from that overall reserve release?
This is absolutely the critical insight for you listening. You hit it right there. The source documents explicitly state the reserve release was, and I quote, partially offset by emerging economic uncertainties. And that auto segment might be the flashing warning light for those uncertainties. Auto loan performance can often be a bit of a leading indicator for broader consumer stress.
Why is that?
Well, the asset, the car, depreciates quickly, and these loans are often held by borrowers with slightly lower credit scores. So stress can show up there first.
Right.
So the big question now is this 28% jump in auto loan stress just an isolated problem in one specific part of their business? Or does it signal a wider economic slowdown that will eventually hit the much larger but currently stable card portfolio maybe next quarter or later next year?
That's a key tension.
It really is.
Yeah.
And on the balance sheet, that tension means the overall allowance coverage ratio, the total reserves compared to the total loans, actually ticked down slightly, went from 5.43% to 5.21%.
So that decrease shows they're feeling more confident about the huge card book despite the clear stress popping up in auto.
That seems to be the calculation, yes.
Okay, given all this, the massive integration costs, the huge growth, these mixed credit signals, we need to check on the fundamental health, the structural security of the bank.
Absolutely. Do they have the capital foundation to handle all this? Plus, maybe absorb a shock if things get bumpy?
And the answer seems to be a pretty strong yes. The structural health looks really good. Their key capital measure, the Common Equity Tier 1 or CET1 ratio, that actually increased during the quarter, ending at 14.4%. That's well above the regulatory minimums. They're clearly well capitalized.
Very solid capital base.
And on the liquidity side, they're holding total liquidity reserves of $143.1 billion. And their average liquidity coverage ratio, the LCR, was strong at 161%.
So plenty of capital, plenty of readily available cash. That's exactly what you want to see during a massive integration like this.
Right.
And that financial strength translates directly into what they're signaling to investors. And this is where it gets pretty interesting for anyone watching the stock.
What are they doing?
Well, first, they bought back $1 billion worth of their stock in Q3. But now, effective immediately, the board has authorized a huge new repurchase program up to $16 billion.
$16 billion. That's massive.
A very big number. And on top of that, they announced they expect to increase the quarterly common stock dividend, bumping it up to $0.80 per share starting next quarter, Q4.
Okay, so a huge buyback authorization and a planned dividend hike.
Exactly. And doing both those things together is, a classic management signal of confidence.
Right. They're basically declaring they believe the merger is already paying off financially.
And that it's going to generate substantial free cash flow going forward, enough to return a lot of it to shareholders even while they're still integrating.
Okay, so let's try to wrap this deep dive up. Q3 2025 for Capital One was really defined by, unprecedented top-line growth and that excellent UNIM expansion, all clearly driven by getting Discover fully into the mix.
Yeah. And once you adjust out that temporary accounting noise from the deal,
Right, the integration costs and amortization.
the underlying results show pretty robust capital generation and strong immediate operational performance lift from the acquisition.
Seems like the initial shockwaves are settling, like you said at the start.
I think that's fair. The immediate financial volatility seems to be calming down, which definitely reinforces management's whole narrative that this was a truly transformative deal for them.
The long game.
Right. The long-term profitability, whether this decade-defining merger is ultimately judged a success, that's going to hinge entirely on how well they monetize those incredibly highly valued purchase credit card relationships.
That $10 billion PCCR asset again.
That $10 billion bet on customer stickiness and synergy realization, that's where the long-term value creation or potential destruction really lies.
And that brings us perfectly to the final provocative thought we want to leave you with to explore on your own. These financial documents, they paint two very different credit stories unfolding at the same time.
Yeah, it's quite the contrast.
On one hand, you have improving credit performance in the absolutely massive card division, stable enough that they actually released reserves.
The good news story.
But, sharply contrasted with that, you have the clear deterioration in the consumer banking auto portfolio, that 28% jump in net charge-off.
A potential warning sign.
So
Yeah.
for you, the curious learner, the question is, which of those credit trends, the improving outlook in the giant card business, or the increasing stress starting to show in auto loans, which one will prove to be the more accurate leading indicator? Which narrative is going to dominate their financial story in Q4 2025 and beyond? Go explore that question.